In 2026, the most important financial story is not a crisis. It's a calendar. This year, nearly $9.6 trillion of U.S. government debt is scheduled to mature and must be rolled over. That figure represents more than a quarter of the country's entire debt, all coming due in a 12-month window. On top of that, corporations globally need to refinance about $2.32 trillion. This isn't a forecast, it's a schedule. It's called the maturity wall, and it marks the next phase of the Everything Repricing. The headlines about inflation cooling suggest the worst is over. But the first phase of repricing, the shock to bond prices, was just the warning siren. The real shift happens when higher rates move from market screens to the balance sheets of companies and governments. The fallout from the end of free money is structural, and it's already begun, driven by the inescapable force of the maturity wall. For over a decade, money was cheap. For companies, governments, and property owners, it was a golden age of borrowing, locking in loans at 2 or 3%. But all debt is borrowing from the future. That future is here. 2026 isn't about a new shock. It's about an old bill. Start with the U.S. government, which has to roll over roughly $9.6 trillion of its national debt this year. That's not new spending, it's existing debt coming due. This wasn't an accident. As the Federal Reserve began its historic rate hikes, the Treasury bet on short-term borrowing, issuing trillions in bills maturing in months or a few years, assuming rates would soon fall. The 2026 maturity wall is the direct result of that gamble. Now, layer on the corporate world. According to S&P Global, companies globally need to refinance about $2.32 trillion in debt in 2026. In the US alone, it's over $1 trillion. Much of this was issued in 2020 and 2021 at rates between 2 and 3%. Today, those same companies face refinancing at 5 to 7%. The math is stark. For every $1 billion of debt a company refinances from 3% to 6%, its annual interest expense jumps by $30 million. That's money that no longer goes to hiring, R&D, or new factories. Phase 1 of the Everything Repricing was the shock to bond prices. Phase 2 is how higher rates pass into the real economy. We're seeing a flood of new corporate bond issuance, not because business is booming, but as a race to refinance before rates potentially climb higher. So where does this pressure show up? The mainstream story points to strong S&P 500 earnings forecasts and says all is well. But that headline number hides a messier reality. The repricing is creating cracks in 3 key places: corporate earnings, credit markets, and a great divide between sectors. First, earnings. Strong S&P 500 growth forecasts assume profit margins stay near historic highs. How is that possible when the cost of capital is structurally rising? For many, it won't be. While the Magnificent 7 tech giants are expected to post strong growth, the picture for the other 493 companies is far tougher. They are squeezed between decent revenue and financing costs that are doubling or tripling, a story hidden in reports of slower profit growth. Second, the credit markets. Credit spreads, the extra interest investors demand to hold a corporate bond over a safe government bond, are incredibly tight. This suggests the market sees almost no risk of default, a system priced for perfection. But this calm is deceptive. A historically normal shift in high-yield spreads from 3% to just 5% would reprice trillions in corporate debt almost overnight, forcing a severe reevaluation of risk. With spreads this tight, there is zero room for error. Third, this pressure is creating a great economic sorting, splitting the economy into 2 camps. The winners are companies with fortress balance sheets, low net debt, strong free cash flow, and long duration financing already locked in. The losers are companies that gorged on cheap debt. They have heavy dependence on short-term refinancing, thin margins, and weak balance sheets. For them, the maturity wall is an existential threat. If you think this is just another rate cycle, here's what makes this one different. For 15 years, the answer to any problem was lower rates and more liquidity. That option is now severely constrained, forcing a discipline that has been absent for a generation. The sorting mechanism is no longer just about growth potential. It's about balance sheet quality. This great sorting isn't a temporary cycle. It's a structural reset. 2 sectors show this split perfectly: commercial real estate, and parts of the tech industry. Commercial real estate, CRE, is ground zero, facing its own maturity wall of nearly $936 billion in loans this year. Many were taken out at 3 to 4% and now face refinancing at double those rates. With rental income unable to cover new mortgage payments and property values falling, owners are trapped. The old strategy of extend and pretend is running out of road, forcing distressed sales and creating opportunities for cash-rich investors. Contrast that with the tech titans driving the AI build-out. Despite massive cash flows, they are launching the biggest capital spending cycle in history, potentially issuing tens or hundreds of billions in debt for data centers. They can handle it now, but their future is directly tied to the cost of capital. Any slowdown in the AI payoff will be punished hard by a market obsessed with discipline. This new hierarchy is reinforced by two structural shifts. First, the government's own debt problem. The Congressional Budget Office projects that net interest payments on the debt will top $1 trillion in 2026. This creates a crowding out effect, setting a high floor for interest rates for everyone else. Second, the buyer of last resort is gone. For years, the Federal Reserve was a massive buyer in the bond market, artificially suppressing rates. That era is over. The Fed is shrinking its balance sheet just as the supply of government debt is exploding, all but guaranteeing the cost of capital will remain structurally higher. The age of financial engineering is ending. The age of capital discipline is replacing it. The most important phase of the great repricing has begun. It has moved from bond charts to company balance sheets, driven by the relentless math of the maturity wall. This is a fundamental shift, creating a hidden divide in the economy. The market is now rewarding strength and punishing weakness. It favors fortress balance sheets over leveraged growth stories. It demands real cash flow, not just narrative. The next few years will be defined by this ongoing structural reset. The winners will understand that the cost of money is no longer a rounding error. It's the primary driver of everything. The losers will be those waiting for free money to return. This brings us to the new strategic question. In a world where refinancing is no longer optional, but inevitable, who survives? To understand how this new era of capital discipline will reshape industries, make sure you subscribe. We analyze the trends mainstream finance often ignores. Let me know in the comments, which industries do you believe are best prepared for this new reality, and which are most at risk? Thanks for watching.